So the quote goes, if I remember, the wife goes, my wife, she sends a quote out to the chat saying, "It is impossible for a man to learn if he already believes he knows it, or even if he thinks he knows it," something like that. I think the phone was causing some disturbance. So my 7-year-old, after half an hour, sends a message saying, "Mom, I think we're off the hook. Hey, Dad, why don't you be more open to learning?" All they read was the man in the quote, right? So it's Dad now. Anyways, who all here would describe themselves as curious? All right, so it's with that same lens, we're going to apply that for the next 15 minutes as we talk about sweat equity. And sweat equity is all that is your blood, sweat, and tears that you're investing every day in one of your most valuable assets, which is your business, right? And every day you're making choices that increases the value or decreases the value of that sweat equity, right? And like it or not, know it or not, those choices only fall under three big categories. Well, the first one is about building your business, right? Which is everything that you do, but you're doing it better. Coming to a stage event, taking a nugget back and helping your business grow, that's about building your company. Investing in your salesperson or another product, another market, that's about building your company. You're increasing, your whole goal is to increase the value of your equity in the business, right? In other instances, you notice that, to be relevant 3 to 5 years down the line, you've got to acquire new capabilities, right? And when you do so, there is a clear business case to be made, if time is of the essence or otherwise, to actually go out and buy companies or buy capabilities. So think about this, right? You heard blockchain. Walmart has adopted blockchain, and it's requiring all its produce suppliers to transfer and adopt blockchain by IBM's blockchain by the end of next year or September of next year. So think about it. If you've been doing business one way, and now you have to now change and shift course and adopt capabilities, what are you going to do? There's a clear case to go out and buy, right? And when you're buying and building your business, you're clearly monetizing your equity because you're reaping dividends from it, right? There is a third choice as well, and the third choice is being acquired, right? There are some clear signals why it makes commercial sense to do so. Sometimes you're at the fork in the road. One road is modest growth year on year, or the other hand, on the other side is step change growth. And you realize that, no, you got to get a partner in to grow bigger faster, right? Or in other cases, you want to take some chips off the table. You've been at it probably for 3, 5, 10, 40 years, and it's time for something new. At that time, it's better to be out of the business and let the business continue to grow, right? So there are many reasons why business owners find themselves making the choice of being acquired. But know that when you make that choice of being acquired, right? Whether you sell control or even minority stake in your business, that is the time you're actually taking your sweat equity to the bank. So the question is never if you're going to take your equity. The question is when you're going to take your equity to the bank, right? And the goal over there should be about maximizing it, right? And when we say taking your equity to the bank, so think about it, right? It's monetizing, it's in chunks, or there's a lot of things you have to also do to ultimately get there, but timing, let's face it, timing is the most critical. What we're going to talk about here is the when, not the how today, right? And before we get there, I think that's, working with business owners, privately held, family-owned business owners, especially this is true in the last 2 years, is that every business owner that we have met has 1 or 2 offers, unsolicited offers, on their table for their business to get acquired. We met business owners today here that have some offers on the table to get acquired. The thing is, 10 out of 10 of those business owners do not know if it's the best offer for them or it's the right offer for them. How would you? It's a one-on-one conversation. You don't know what the market would actually pay for your business. You know what the offer says, right? So take an example of a local manufacturing company that we were helping in Southern California. There's a lot of things you have to do when an owner chooses to exit, right? To get from point A, when you start the process of marketing to company, to ultimately when money hits the bank. What benefited the owner as he wanted to diversify his wealth, he saw 12 different offers, more than a dozen offers for his business, and the spread between the lowest offer and the highest offer was anywhere from 1.25, 1.5 to 2x. So the offer that you have on your table right now, is it the lower tier offer? Is it the premium offer? You don't know because you're not in the water. Price is one thing, then there's terms and fit, right? Then you talk about Fortune 500 companies. So we work with some of them. These are public companies, and their clear mandate right now is to go out and acquire capabilities because they're worried that they see two things. The next 3 years are going to be more important than the last 50. And they're worried about their products and services being relevant in the next 3 or 5 years. So instead of disrupting their organization, they're actually making a pretty good case to go out and buy or acquire those capabilities. But now when you sit down and actually speak with them, what kind of company do you want to go after? Do you want to acquire people? Is it the platform? Are you going to run the business separately or going to integrate it? Do you want to talk to targets or sellers who have already demonstrated or stated that they want to sell their business? So there's many bidders already in the pool and you'll be paying higher? Or do you want to have a one-on-one conversation with a potential seller? Less than a third of them, of all and everyone we've spoken to, less than a third of them have actually an execution plan to get there. Right? And you saw the dichotomy here. When you want to go out and buy a business, you actually want to have a one-on-one conversation. But when you're on the other end, when you're selling your business, you want to have many conversations because that's ultimately going to get you a market clearing price, market clearing terms, and a market clearing fit. Right? And so the point over here is, doesn't matter what you're doing to build your equity, which is attending stage events, buy companies to grow your equity, or even be acquired or sell your company to bank your equity. Know that there are partners who do this for a living, right? And as much as those partners want to build relationships with you, I would say, I would ask the room that it's also incumbent upon you to actually cultivate those relationships. You've got to start to get to know some of these partners and know that they have your back when the time is right. With me so far? All right, so let's talk about timing. In our perspective, the right time is not next year when cash flows are higher, right? We had an HR technology client. They came, said, I think we want to sell our business. This is the right time for it. Let's go start the process. One of the bidders in the process was a company that they had turned an offer down just 6 months earlier. It was a large public company. Why? Because they were going to be much bigger next year. Their cash flows were going to be higher, and there would be a higher multiple applied to it, and therefore a bigger payoff. And then the founders were surprised when that public company actually bid an offer. The offer price was 20% lower than what was on the table 6 months before. Why? Because the company, the acquirer, actually had a need at that time. They went out and acquired another business, and now their perspective on valuation changed. Happens all the time. Where we have seen by being in the business that owners have been able to really maximize value is when three forces align. And if you've already sold a company, you're sitting here, you've already sold a company, think back. This will likely hold true for you. For the first thing is your personal disposition, right? Are you ready to hit the beach? Do you still have some runway left? Do you have liquidity issues, or do you just want to take the chips off the table? When you have some runway left, 6, 12, 18 months, 9 months, whatever that is, that actually lowers the transaction risk for the buyer. Lower risk means they'll be able to share higher premiums, has an impact on valuation. The business, where your business is in its maturity cycle, is it growing? Is it steady? Or is it in a decline mode? Are there opportunities to still grow your firm at reasonable cost, right? So buyer comes in, can they just continue to do what you do and grow the company? That's great. What's happening with your competitors? Are they getting acquired? If yes, you actually want to be in the first tranche of being acquired, not the latter tranches, because they've already made a lot of those investments. The value goes down the later you are in the line to get acquired. And then lastly, the market, right? Is it a healthy M&A market? Are there buyers that are buyers active? Do enough opportunities exist for roll-up acquisitions? Is there volume of activity happening? Are the credit markets receptive? Right, all of these, there is no one silver bullet. If you were to do an assessment, if you're in your spot as a business owner thinking about this and doing an assessment, it will likely be different than anybody who's sitting on your left or your right. And if luck by chance it's the same, then it's great, we're all in the same boat. just a little bit in terms of just some data that you want to see here. At the back, can you see the yellow line and the blue, right? So the blue line is public companies, S&P 600. It's all of the companies with market capitalization less than $1 billion, right? It's public companies. And you're seeing the percentage change since 2007 of their stock price. And the blue line is what we call an M&A index, is what we have developed as a way to kind of to get a sense check on the health of the M&A markets. And it has a lot of factors in it, including volume, including pricing strength. If I were you as a business owner and interested in knowing what this means, here's what I would be thinking. I think the public company multiples have gone up. Stock market's gone up 2.5 times since 2007. My portfolio has felt it. I feel good about it. Now, if I think about the M&A markets, I see that they are up as well compared to 2007. And they're hovering around some of their highest points. And the questions are, if the stock markets continue to grow up, do you think the M&A markets will go for a 1-on-1 increase? Likely not, because the data is not showing there. You're seeing the data like this, right? So the stock market continues to go up. There's a question whether M&A is going to go up in a linear fashion along with it. The other thing I would be thinking of is, if there is a downturn in the market, or a correction in the market, what's going to happen in the M&A market? Think about it. If there's a downturn in the marketplace, economy is shrinking, everybody's perspective of the economy is glooming, and if you actually take action, you get double dinged because potentially your earnings are lower and or the market multiples are lower, so you get double dinged. Right? So then your mind starts to wander around what can you control and what's out of control. You think about what is out of your control, the height of the wave, how high or how low, you can't control that. If the wave is over, the next wave to start, there's a lull period in between, you can't control the lull. If there's a downturn in the marketplace, how much you get impacted adversely, you can't control. It's a systemic risk. If the market there's a downturn, you're just by being in the business of doing business, you get impacted. And I think it works well if you kind of market goes up as well. You enjoy the benefits of the market overall moving up, right? But then if it is a downturn, there's an emotional stress of managing through that and any financial capabilities that you need to kind of work through that. But what can you control? You can control the choices that we were talking about, the forces, your assessment of the forces. If now is not the right time, when is? And if it's the right time, are you prepared for it? What are you going to do? Just like a surfer, right? If you want to go out and surf, first you got to be in the water. You're thinking about your gear. You're thinking about the weather. You're thinking about the location. You got to think about getting your core strength up. You got to know basic surf moves. And you got to think about fuel because you got to remain hydrated. So punting those conversations off for a later time, all the time thinking, maybe not now, maybe later, is like saving up on sex for old age. Right? In the end, this is what I would leave you with. If there were 3 things, back when I attended MIT, there was a class professor who would always do experiments. He would divide the class in half, and he would give them 2 choices to make. They would have different odds, but the same outcomes, right? And you had to do it under different circumstances. Long story short, what are the results? We all tend to make conservative decisions when the going is good, even with the outcome being the same. And if we are put into a corner or have pressure, we actually end up making riskier bets. So in a room full of business owners, what I would ask you is that us as decision makers, should it be the other way around? Right? And there's no question, sweat equity is the most valuable equity there is. Right? We've talked about ignorance is not bliss when it comes to this. The question is, we believe that the surf is up right now, right? So if you've ever thought about wanting to take your equity to the bank in 3 to 5 years, what we advise is you want to be in the waters now and at least explore what that maximizing your sweat equity means for you. Right? And even if you're looking to grow, these are actually also good times because more business owners are open to having a conversation with you about being acquired. Because for every business owner that may not be ready, there are others for which the balance of the forces all align. And then lastly, I'll leave you with this one thought. Sometimes the riskiest thing you can do is to maintain status quo. Thank you, and I look forward to getting to know each one of you later through the day.